Hi everyone. Our topic is amortization and income tax. It's by Krul and Aryan.
What is the CRA? The CRA stands for Canada Revenue Agency. They administer tax laws for the Government of Canada and for most provinces and territories. Also responsible for ensuring everyone complies with these tax laws on behalf of the government across Canada. This relates to amortization because it allows taxpayers to deduct amortization expenses while calculating taxable income. What method does CRA require a company to use? The CRA requires companies to use the declining balance method when calculating depreciation. The first year an asset is owned, 50% of the asset's cost is eligible for depreciation. This is also referred to as the 50% rule. What is the CCA? The CRA does not allow taxpayers to estimate the amortization rates of assets. It groups assets into various classes and provides maximum amortization rates for each class of capital assets. Amortization allowed for income tax purposes is calculated on a group basis and is called capital cost allowance. Capital cost allowance is a tax deduction or depreciation that Canadian tax laws allows businesses to claim for the loss in value of capital assets as they wear out over time. You use the capital cost allowance rates in the description below. The rates differs between classes as buildings depreciate the slowest and computer softwares depreciating the fastest.
Okay, so the alternative way of calculating amortization expense, which is the wrong way, is the straight line method, which is the cost minus residual value divided by number of estimated years. That's the wrong one. There's no other way to calculate the CRA. It requires you to use only the declining depreciation method. Method stability. The method provides declining amortization expense because declining balance method involves the spreading of costs of an asset over its life, which results in declining depreciation charges each successive period. Example 1. SolidWorks Inclusive buys metal sheets that are to be used in a construction project to be built over the next 4 years. The total cost of the sheets is $3,200, depreciated at a rate of 25% each year. Remember that you guys have to use the 50% rule and applies to the example 1. Calculate the depreciation expense after the completion of the period. Okay, so for the first year, the net book value is 3,200, which you multiply by the rate 0.25%. You will get the depreciation expense, which is 400, and the accumulated depreciation is 400. The net book value for the year end is 2,800. So the declining expense after the completion of the 4-year period is $393.75.
Created using Powtoon.